Hello, everyone. I'm going to be covering some high-level trends from what we see in the economy and specifically what we also see going on in the auto market through the lens of what dealers are seeing. And then my colleague, Kevin, will be addressing more details that I think will help you navigate what's going on in the current market and what we're expecting in the months ahead. So I'm going to start first by focusing on COVID-19 itself, because we're actually at yet another interesting junction in the data, because we're now, enough time has elapsed past Labor Day that we're starting to see the effect of behavior that changed Labor Day weekend, and we're now seeing an increase in cases. So if you look on the next slide, we do an analysis of the pandemic where we look at the level of risk by county across the country. And basically on this map, you want to be yellow or blue. You don't want to be red or orange, because the red markets are the places where the highest risk. And unfortunately, if cases are increasing, as it appears is the case now in mid-September, and likewise deaths are on an uptick too, it means the risk is not going down, it's increasing again. Where we see the biggest concern presently in terms of major markets in the country, they're mainly in the states of Georgia, Louisiana, and Texas. As we navigate how that impact has looked on the economy, the next slide shows you what GDP has looked like. Specifically, this is charting the quarterly annualized change in GDP back to 2000. This chart is showing us the quarterly annualized change in GDP going back to 2000. And you can see the impact of the pandemic. It's screwing up the axis on the chart, and I guess that's something I'm going to be living with for the rest of my career. We saw a 5% decline in the first quarter, and that's what we typically see as a significant decline during a recession. But then that was followed by a whopping decline of nearly 32% in the second quarter. The key question, of course, is where do we go from here? And I'm sure you've heard talk of whether or not the recovery is going to be shaped like a specific letter, the letter V, a letter U, a letter W. Well, I'm with the majority of economists who really don't like the letters and think that instead it's going to look more like a Nike swoosh. And what is meant by that shape is that we essentially have a very strong initial bounce, but then it takes us a longer amount of time to truly get fully recovered. So we're actually forecasting a huge 24% bounce that, yes, will screw up the axis on this chart even more. But from there, we're expecting to struggle to get back to prior levels of activity. And it's because of the virus. The virus limits activity, and that's especially true for sectors like travel and hospitality and many services. We don't really expect business as usual will return until we see the risk of the pandemic greatly diminished by vaccines. As we look then to the impact to the labor market, unemployment clearly has been a key indicator to watch. The consumer represents about 70% of the US economy, so it's vital that we see those consumers employed. And we have seen an impressive recovery of almost 11 million jobs over the last 4 months. But it leaves us with almost 13 million on traditional unemployment benefits as of now. And the recovery has slowed down actually over the last 2 months and may have actually even completely stalled out at the beginning of September. When we look at how this then is impacting different areas of the country, we have different impacts because we have some regions of the country more dependent on travel, more dependent on services. So the next slide shows you what that unemployment looks like per state. So in our latest data, we have a little bit less than 13 million on traditional unemployment benefits. That's roughly 8.5% of February's jobs. But when you look at it by state relative to the jobs and the number of people unemployed, you definitely see more issues in states like Hawaii, California, Nevada, and New York. And as I mentioned, the inconsistent trend that we've been seeing and the slowing trend in the job recovery really indicate to us that we're at a stage in this recovery where just about most of the jobs that we're seeing added are being overwhelmed by new jobs being lost as some of the sectors struggle with getting back completely to a normal level of activity. And a metric that's always very correlated with unemployment is consumer sentiment. We've been tracking daily readings of consumer sentiment from a firm called Morning Consult. And the good news there is that as we started to see COVID-19 trends improve late this summer, really starting in August, we've had 6 straight weeks of improvement in that data. But as I mentioned on the outset, if the COVID-19 cases are now increasing again because of more lax behavior over Labor Day weekend, we can expect to potentially lose some of that positive momentum over the next few weeks. And just like with unemployment, if you look on the next slide, you see maps of the United States looking at this consumer sentiment data. The map on the left is looking at the largest DMAs in the country and what their current consumer sentiment looks like compared to the end of February or before the pandemic began. We've only got one market in the country currently that's got higher consumer sentiment. It's just barely higher, but it's our sole green market on the map, Binghamton, New York. We've got 26 markets in yellow. They basically are less than 15% down, so they're doing better than the majority of the country. 105 markets are down between 15 and 30%, which is basically right in line with the US. And we've got 10 markets that are down more severely, more than 30%, and those are the markets in red. The map on the right is showing you specifically the trends we saw in the prior week. And we have been seeing more improving markets than declining markets, and that was the case last week. But now as we're seeing the COVID-19 trends potentially move in the wrong direction, I suspect over the next couple of weeks, through the end of September and into October, we're likely to see those trends potentially reverse. But now let's talk about the health of the consumer financially. And I can absolutely say that our situation today could have been much worse if the US government had not acted quickly to help support consumers and businesses as they did, especially back in the spring. We had unprecedented levels of fiscal stimulus and monetary action in March and April, and that really helped households stay whole. In fact, the data that I'm showing here shows you that incomes actually went up instead of falling when unemployment was at its absolute peak. And that was a product of the CARES Act and the payments that were provided by the CARES Act, as well as enhanced unemployment benefits that lasted until the end of July. At the same time, we consumers couldn't spend, especially on events, travel, sporting events, and so savings shot up. So the households have been fairly well taken care of, at least through July. And if you don't think that those payments didn't really have an impact, our analysis of the data that the Fed reports on savings accounts at commercial banks indicate that an additional $1.6 trillion were put into savings accounts between the end of February and mid-July. So what that left us with is essentially consumers who were able to keep current on bills, potentially even pay down some of their debts. But now we're in a situation where those stimulus or payments are well in the rearview mirror. The unemployment extended benefits expired at the end of July. And so far, Congress has not been able to put together a new package with the Democrats and the Republicans fairly far along. So basically, we're expecting performance potentially to deteriorate because of so many on unemployment and dependent on that support they receive from the government. When we look at how that has impacted auto loan performance so far, we actually clearly see the impact of the support the government provided. Consumers use that extra money to pay down their debts, including auto loans. And consumers also benefited from something else that really had an impact on severe delinquencies. And that was loan forbearances and accommodations that have led to us seeing, as shown on this chart, declining delinquency rates across all loan types, but here we're looking at auto loans specifically. And that severe decline in delinquency rates has occurred in both the market overall as well as in subprime. And subprime is a key part of what drives repossessions and challenges in the auto credit market. Accommodations were as high as 8% at the end of June. Since then, we're seeing accommodations come down. We're down to 4.2% at the latest data available, which was for the end of August. So what do we take away from that? Loan performance would have been worse, and it's likely to get worse before it gets better because of the stimulus waning accommodations starting to end, and no longer seeing additional unemployment benefits. That is translating into some interesting dynamics in the credit market, because while we can see that consumers have seen lower rates on most types of loans, consumers with poorer credit are not necessarily seeing much of a benefit in lower rates. And some consumers actually appear in the data to be pushed out of the market entirely. Basically, the Fed cut official rate policy all the way to 0 back in March, and we've seen Treasury yields come down since then, largely following. But we're not seeing a consistent pattern in auto rates. And in fact, in the month of August, we saw auto rates across the board move up slightly relative to they had been earlier in the summer. And that's because lenders are basically perceiving that there's more risk than the delinquency data has been showing, and that's making them become more conservative. And that conservatism means two things that are really important to the auto market. One is it widens the spreads and doesn't necessarily provide consumers, especially like subprime consumers, better rates than they have been seeing. In fact, a subprime consumer is looking at a rate that's more than a full percentage point higher right now than it was a year ago. And then the other thing that it's doing is basically making it much more difficult for subprime consumers in particular to get loans in the new vehicle market. So that has been one of the reasons why the used market has been so strong. A significant portion of subprime consumers are essentially shut out of that market. So the used market has been strong. Kevin's going to share with us a lot of detail on that, but let me highlight for you what vehicle prices have done. On this next chart, you see the Manheim Index, which we report in full every month, and we've seen used vehicle prices shoot up. And I have dealers ask me all the time, what exactly does the Manheim Index represent? Well, simply put, it represents what dealers are paying for used vehicle inventory at auction. And what the numbers tell us is that they paid more than they ever have by a long shot this summer. And I'm sure you've all been experiencing that. We had increases and producing records on the Manheim Index in June, July, and again in August. We are expecting when September is done that prices will have peaked in August and we'll see prices coming down. But you can see that unless we have a major correction, which we're not expecting, we're still going to be dealing with very high prices. So let me close out with some views of dealer sentiment to show you the roller coaster ride you've been on, and I hope you get some feeling of confidence from the fact that you haven't been alone. We do quarterly surveys of dealers across the country to see how they feel about the current market, what they're expecting about the future, and the issues that they're facing. We had a record low in that consumer sentiment in the second quarter, followed by a record increase that gave us a record high in the aggregate in the third quarter. But note that there is a big gap that has been created between franchise and independent dealers, with franchise dealers having consistently a number above 50, which basically means the majority say that the market is strong, whereas with independents, we definitely saw much more of a struggle back in the second quarter, and now they are above 50, but their view is far more tempered than the view that we see from franchise dealers. And then the view of the future is a little bit more negative, especially when we look at independents, as shown on this chart. Franchises see the next 90 days as strong. Their number is 60 and looking very positive, but the independent number is back below 50 again at 46, which means the majority of independents are saying you expect the next quarter to be weak rather than strong. And from a historical perspective, you look back over the time we've been conducting this survey since 2017, the future expectations for independents have only been lower once, and that was last quarter. So I think independents are feeling more challenges. And if you want to see what the number one challenge in the market is, it's a no-brainer, it's inventory. The next slide is showing you, we ask a series of factors to be ranked on what's holding back your business. And the majority of independents cite inventory as the number one factor, with COVID-19 as second. You can see those two, swapped places from the last quarter. but there's no question that inventory, and a focus of a lot of the rest of the presentation today, is going to be the biggest challenge, not just now, but likely over the next several months as well. And that ties to what dealers tell us, and particularly independent dealers tell us their top priorities are. The next slide shows you that while there's been an improvement in what those top priorities represent, meaning that fewer independents are saying that their top priority is simply staying in business, we've now seen finding and buying inventory become the top priority. So it's very consistent. That's the challenge. That's the priority that dealers are facing. And we see it very evident in the trends that we're reporting. You'll note that it's also a top priority for franchises too, but it's not quite as high. And inventory access is likely the key factor that separates the outlooks that I shared of franchises being more positive and independents being a bit more negative. So that's the perfect segue for me to hand off to my colleague Kevin to dig into more of the detailed market trends.
Thanks, Jonathan. Like you said, we're going to take a deeper dive into some of those key trends that are driving some of those sentimental feelings by the dealers. You know, when we start working our way out of September now and start looking at what really has driven the marketplace, we had a tremendous amount of response to that government stimulus program. It drove the incredible V-shaped recovery in the used car market. While we're expecting more of the Nike swoosh for the entire market, the used car market itself really has been more of a V-shape, and we'll show you some of that. When we look at retail sales, they are now starting to slow down after that incredible recovery that we saw in the June and July timeframe. We're looking at inventory as, you know, the dealer sentiment indicated. There's some significant shortages of inventory across the marketplace, and we'll look at those shortages as we go. And resale values have been on a wild roller coaster ride since April and have appeared to hit their peak here in late August and early September, and now we're seeing more of a normal kind of seasonal pattern. And retail prices are still rising a little bit in response to that growing wholesale value. But as we look forward, right, absent another round of aggressive government stimulus, as Jonathan said, it looks like we're headed toward its peak right about now, and we'll be slowly drifting our way into the fourth quarter. So let's take a look at those retail trends. So here we have two different sets of data that we're looking at. On the left in the blue section is dealers that we source out of our vAuto data set. And on the right in the green is a set of dealers that we pull from DealerTrack. The difference between the two data sets is the left is made up more of some of your larger and franchised type dealers, while the data set on the right has a stronger mix of independent dealers and smaller dealers. So we get a bit of a feel for how the marketplace is performing for the larger dealers versus some of the smaller dealers. And in this data, you're definitely going to see the difference that's driving that sentiment difference between the very large dealers that Jonathan talked about versus the smaller independent dealers. When we look at the far left graph, that rolling 7-day, the green line is the volume that we sold last year, and the blue line is this year's volume. Of course, you can see the big giant COVID crash after what was really a pretty strong spring market from a volume perspective. And then that incredible rebound on the overheated market that we saw in June and July, and now kind of drifting our way back down to a more normal pace. When we aggregate that data into monthly buckets, we look at that incredible June month. Many dealers had record profits in June. Sales were up 16% year over year for this group of dealers. In July, up 7.3, two incredibly strong months, followed by August, where we really saw things slowly start to cool down. And it's not coincidental that August is also the first month after a lot of those stimulus programs and employment support programs expired. When we look at and isolate the very last week of August, you can see that it underperformed the entire data set and was about 2% or so below prior year levels. When we look at the data in September, it's very reflective of that last week in August. So the September numbers, when we publish those in another week or so, will show that kind of decline. When we look across the top key states, we just grabbed 12 of the top 20 volume states to kind of chart the path of how things were in the spring market, how COVID impacted those states, and then how each of those states came out. The dotted line states represent the states that generally did not go as deep into the lockdowns and came out earlier. And you can see that their crash into the COVID window there is a little bit more muted than the other states. And then they came out in a roaring fashion starting in mid-May and into June and July. And they were up, 10, even 20% over prior year. The other states, right, that were more impacted by the virus, as Jonathan said, this continues to be a key driver for us. They came out, they went in deeper, came out later, but now are sort of catching up with some of that pent-up demand. You can see those solid line states are still generally above kind of that 100% barrier. But in the end, as we look to the far right here, as we're heading through the month of September, all the states are now starting to generally bounce around in that 100% range and a little bit lower. So we're heading back down toward what I would consider to be a more normal phase. For this, I just kind of wanted to give a quick snapshot of a week or so here as we came out of August, just to show the difference. Had we taken this exact same snapshot and looked at it at the end of July, the chart would have been completely reversed. The vast majority of the states would have been seeing year-over-year sales growth in retail sales. But now, as we exited August and now into September, the vast majority of the states are under. And you can see that the performance is wildly different state by state. Many of the states and many of the large states are relatively close on either side of that 100% barrier. But we do have some real strong spots. It's Florida up there, over 110%, New York in that same neighborhood, Arizona, New Jersey. Those are 4 states that are all on that top 12 volumes set. Then we drift our way lower. One of the states that I find interesting really is taking a look at Texas. Look at Texas is a little farther down on that chart, almost all the way to the bottom left there. They came out of this much, much earlier than others. We had a very strong sales rate in July, and now they're kind of paying for it a little bit as we have a little bit more problems with the virus. So again, the virus is continuing to be a big storyline, and we're watching a broad-based retail sales slowdown that's evident as those stimulus programs expire. So with that, I'm now going to flip over. I'm going to take a little bit of a look here at the supply situation and some of those things that dealers were kind of indicating in their sentiment indexes. Top left is year over year, or is a comparison between retail sales and retail acquisitions. And when the green line is below that black 100% line, it represents a period of time where dealers are reducing their retail supplies of inventory. And you can kind of see in the COVID window there as retail collapsed and acquisitions continued, they built some inventory. But since then, they really depleted a ton of inventory in that window between basically the early May portion all the way until mid-July. And now we look again, they're finally starting to add to inventory again. So it's starting to fill some of the holes that built up on their lot. Far right-hand side there is the days supply. And you can see that we have been trending well below prior year levels since we came out of COVID. We are now starting to normalize as retail sales slowly come down and those acquisitions slowly catch up. And in September, when we update data again, I fully expect that we will see retail days supply overall will be back to kind of a normal level in that low 40-day range. Down on the bottom there is just taking a look at the number of listings that we see year over year, gray being last year and the blue line being what we see this year. And you can see since the COVID window there with the depletion of inventory and the growth of sales, the overall volume listed is still about 10% below where we've been last year at this time. So we still have some fairly tight inventory levels, but normalizing a bit on the retail side. Flipping quickly just to look at new, because new car inventory has a huge impact on kind of our near new used segments. So that 0 to 4-year-old used cars influenced pretty heavily by what happens in that new car market. On the top left, this is really a chart that makes this recession quite different than any other recession we've ever seen in the auto business. We had complete shutdowns of North American manufacturing for a very extended period of time. You can see in April there, we almost zeroed out. I think we produced about 200,000 cars in April. A very slow recovery in May. And now June and July, we're finally getting back up toward a more normal production level. But when you look at that COVID window, we've lost 3.5 million units of North American light vehicle production. That's a pretty big hole to make up for. And you can see the impact when we flip over to the chart on the right-hand side of what happened in that same dealer acquisition. So you can see dealers kind of depleting and adding to inventory prior to COVID. And then the huge depletion of inventory as all we're doing is selling and not being able to replace inventory. We're now just barely getting to the point where they're more balanced like they were before COVID in terms of their acquisitions and sales. But on the bottom left, you can see the giant hole that's been left in their inventory. That 3.5 million vehicles of lost production is having significant impact on new vehicle car listings. We're now sitting about 33% lower in terms of inventory available to dealers on lot than we were last year at this time, while sales are running more in that negative 15 to negative 20%. So we still are not in a position where we have completely rebalanced new vehicle inventory. So we have significant shortages, in particular of those popular models, equipment packages, and they're going to continue to be pretty hard to find as we move forward into the fourth quarter. Wanted to just kind of lay out the picture of supply, both new and used together, breaking out three key segments: the sedan segment, the SUV segment, and the pickup segment for both. On the left is new, and you can see that prior to the COVID lockdowns, we're running somewhere in the neighborhood of 100-day supply on a pretty consistent basis across all three of those key segments. Then the run up in COVID, and since then we've really been running under that 100-day mark consistently, and really more in that 60-day and less range. The line that really pops out to me is the pickup truck line, with the explosion of equipment packages and those sorts of things. Typically, dealers carry a heavier day supply of pickup trucks, and you can see that in the pre-COVID window. But now we're down to a 41-day supply on the new car side, which is really, really tight. And when we look at the used car supplies on the right-hand side, we see similar patterns. Again, normalizing overall, but that pickup segment at 34 days is still very, very tight. So when we look across new and used, consumers that are searching for a new or used are going to find some very slim pickings and very difficult. So that means that dealers are probably going to have difficulty replacing that inventory at prices that they would consider to be, reasonable prices. So despite the retail slowdown that we've seen in sales, we are continuing to see some inventory shortages, and we will likely see those shortages continue and stay with us and be a big factor through Q4. I wanted to take another deeper dive look here at the day supply picture on the used side, because we really do have two different markets emerging. We have the near new market there represented by the blue lines and that day supply graph on the left, and the green kind of being in your mid-range to older vehicles. So we're taking out a look at that day supply performance on a age of vehicle basis. And you can see the near new segments are really getting back up toward normal, but we continue to have some real shortages in supply around the 8, 10, and 15-year-old cars, all of them under 30 days supply. The graph on the right-hand side kind of gives us a snapshot of how those supplies stack up versus what we saw last year. And again, you can see that those older vehicles have very, very short supply relative to where we were last year, while the near new segment is getting much closer to normal. This is going to be an important factor when we take a look here in the deeper dive in the pricing trends coming up in a few slides. All right, now that we've looked at the retail inventory supply trends, I want to kind of take a look at what's happening at the auction, which is the supply line for those retail inventories. On that top graph there, you can see the trends of overall commercial inventories that are at auction. You can see going into the spring, we had a very strong spring market, relatively short supply compared to prior years. The big explosion of inventory that landed at auction during the COVID lockdowns. And now we have completely whittled away that entire excess supply. We're now down almost 200,000 vehicles versus that peak in April. And we're even now down 48,000 cars year over year. This is the lowest level of commercial inventory we've seen in probably 5 or 6 years at the auction. So we're getting to a level where, we're seeing some acute shortages of vehicles. When I break out the segments, and the one that I find most interesting is that bottom left, the rental segment. There was a lot of press in that April, May, and June window regarding the flood of rental cars from the rental defleeting that would be hitting the marketplace, and concerns about how it might impact values, how long it would take for us to liquidate that inventory, and those sorts of things. Well, as we sit here today and we look at those inventories have been liquidated in a very, very orderly fashion with almost no impact whatsoever on resale values. We're now down 75,000 units off the peak, and for the first time since pre-COVID, we are even down year over year in terms of the supply of rental cars at auction. When we look at the captive finance inventory, which is primarily off-lease cars, you can see that we're very short heading into COVID, exploded during the COVID window, and again, we are now back to where those are very, very short, and we're down almost 30,000 units year over year. The bank inventory is representative more of the repossession inventories that we have. Again, higher than prior years heading into COVID, the big bump in COVID, and then the forbearances started and stopping production of repossessions and those sorts of things. And we've slowly whittled that inventory down as well. So we're going to see some acute inventory shortages in the wholesale marketplace lasting with us for several months and clearly through the end of the year. With that, I want to take a look at, what do we see happening in terms of two key segments of vehicles coming into the marketplace. On that top left there is the repos and how they're flowing to the market this year versus what we saw last year and even pre-COVID. Blue line being the volume of repossessions working their way into the marketplace, and the gray being last year. The dotted red line is representative of what we thought would happen had we not hit COVID. So it's essentially saying, hey, we were running ahead of prior year prior to COVID. If those trends had continued through the year, that's what we would have expected in terms of volumes of repos coming into the auction. And you can see this huge depression that occurred this year in the repo volumes flowing to the market. So we now are at a point where there's about 350,000 repos that we would have expected to come into the marketplace that have not yet come into the marketplace and are being delayed into the future. Based on our conversations with clients, our expectation is that we may see some of those vehicles work their way back into the market late Q4, but more likely those vehicles will not be with us until we start seeing them flood in the first quarter of 2021. On the right-hand side is the off-lease segment, and you can see it was running ahead of prior year. We're looking at vAuto listings for this, just looking at what percentage of 3-year-old listings are off-lease vehicles, so we can get a pretty good feel for how many of those off-lease vehicles are defleeting. And then you can see the big drop as people put off their decisions around terminating their lease vehicles during the COVID lockdowns. But now those vehicles are working their way back into the marketplace, and you can see the big run-up here that we've seen over the past several weeks. It is interesting that while those cars are making their way back into the marketplace, they are not funneling their way through typical wholesale channels. For the most part, those vehicles are being paid off by the grounding dealers and added to their inventories or wholesaled off. And that's due to the fact that we've had this tremendous run-up in resale values, making the equity positions and the purchasing at residual value more attractive. So again, we don't see huge influxes of volume from two of our key segments coming at least until 2021. So the remarkable rise in resale values. We plunged down into the depths there in April, where it was very difficult to use MMR to even value a car. And now we've recovered completely and then some. That top left graph is what we call MMR retention. That is the actual auction selling prices as a percentage of MMR. When that blue line is above the black 100% line, that's a period of time where values at auction are rising. And the farther that line gets above that black line, the faster the prices are rising. And you can see we had a record 17 weeks in a row of rising prices. And as we were coming out of August, that trend finally came to an end here as we settled in at the 100% mark. Again, when we update the data for September, we'll start to see a slow drift below that 100% mark. So we really do feel like we have seen the peak, absent another round of government stimulus. Top right there, I just wanted to grab a sampling just to show the magnitude in raw dollars of the swings that we've seen in resale values. So we're grabbing a 3-year-old car. It's being representative of what we've seen in the marketplace. And you can see very strong values in that spring market year over year up, then the big plunge. And now we're sitting 11% higher than we were last year at this time. And that's very representative of what we're seeing across the marketplace. I really want to draw your attention, though, down to that gray box as we look at coming out of August. It is two different worlds, that near new market of the 0 to 4-year-olds bouncing around very close to MMR. But as we get into the more aged units, the 5, 6, 7, 8, 9, 10-year-old vehicles, you can see that those older vehicles are the vehicles that are still rising in value. If you'll recall, when we looked at the day supply, those were also the vehicles that were in the shortest day supply at both wholesale and retail. And this may be one of the reasons why we're seeing some of the sentiment differences between the large franchise dealers and the smaller independents that tend to operate more in that lower end segment. So still rising at the lower end of the market, but those two probably approaching the peak as we head out of September. Lastly, I really wanted to take a look at the retail prices relative to wholesale and kind of get a look at the spread between the two, which is kind of representative of whether or not we're seeing more or less profit opportunity for the dealers. The blue lines on the top represent the retail average selling prices. Green line is the wholesale prices at the exact same time. And those gold bars are a 6-week lag between wholesale acquisition and retail selling price. Kind of gives us a feel for, hey, the cars that I bought 6 weeks ago are the cars that I'm generally retailing now. And what does that look like in terms of a profit opportunity for the dealerships? Looking at that blue line, we are now seeing some growth in those retail prices in both the non-luxury and luxury segments. Prices are heading up in response to that tremendous run-up in wholesale values that we looked at on the prior chart. And now wholesale slowly starting to taper off a little bit, at least on the non-luxury side. So we are seeing the spreads kind of normalize a bit. We had a fantastic run where we're acquiring cars very inexpensively in that April and May timeframe and retailing them into a very strong June and July market. So you can see that the spreads in that non-luxury arena grew pretty nicely. And now they're pretty much back to normal. So we'll see where we're heading from here. We may still see some retail growth, but again, wholesale appears to be plateauing. Luxury is a little bit different. We really did not see retail rise the way we saw retail rise in the non-luxury segment. The used car values did rise and continue to rise, and so we're seeing some pressure around those spreads, and now we're a little bit below normal. So my expectation is in those luxury markets that we're going to start to see some more accelerated downturns in resale values and things in response to that. So when we sum it up, retail spreads are really returning to normal after what was a pretty good post-COVID bump. So we'll finish up now. We'll just kind of look at the summary and give you a little bit of our outlook. On the summary side, as we talked about, the government stimulus programs drove tremendous recovery for us, both retail volume and values rising in response to that strong stimulus demand. We saw inventories get very, very tight. They continue to be tight. Now they're a little bit tighter on the wholesale side than they're on the retail side. And auction supplies are really at the lowest levels we've seen in years. We're now starting to see resale values starting to plateau in August. As we update the data from September, it will confirm that trend, and we will see values slowly starting to drift, we think, into the fourth quarter in a more normal pattern. When we look forward, one of the questions that Jonathan and I get asked quite often by clients is, do you think it's possible that we could see a second crash? You know, things have been pretty good. When we look at the trends and the fact that we're really short on supply, we really don't think it's very likely that we're going to see a second crash. It is possible that we could see a second round of aggressive government stimulus, and if we do, it's possible we could see a second run-up in values, much more so than a second run down in those values. So our outlook really is that from here on out, we're going to look much more normal, see a more normal seasonal pattern in Q4. Shortages are going to continue to be a key trend well into Q4. It'll be a while before we see those off-lease and repos work their way in. The shortages of the 5 to 10-year-old vehicles will continue to be with us as we head into the fourth quarter, making it difficult to acquire inventory. And on the upside of this, the rental liquidations really have been very, very orderly and have not been problematic and will not be problematic as we head through the rest of the year. So from a resale value perspective, again, we expect to see a much more normal depreciation pattern as we head into the fourth quarter. So still some wild cards out there. Obviously, government stimulus can change the game. Changes in unemployment can change the game. And of course, if we get a second wave of the virus causing additional lockdowns, that can also change the game. So those three things will continue to be key drivers for us as we go forward from here.